this is probably episode number 5, I think. Last week, uh, Stefan was not last month, sorry. Stefan wasn't able to join us. He was out of commission for a few days, and so it's good to have Steph back and in great health, and the other half of Stef and Drew. Um, what we do in this 45-minute conversation is talk about two products that are not new to the financial planning mortgage industry, but are perhaps quite misunderstood. The first one is reverse mortgages, and the other is the infinite banking concept. Reverse mortgages have had a lot of negative uh, conversations surrounding it, particularly in the United States. And we're going to demystify those misconceptions by explaining what those products are, how they can fit into your financial planning portfolio. The other product is the infinite banking concept, which is an insurance product that has a multitude of uses in the wealth creation journey. And again, many insurance products are also misunderstood by a lot of our consumers, particularly in the Black and Caribbean community, both in Canada and the United States of America. If you have any listeners in the US, the products that we are going to be addressing today are primarily with relation to a Canadian market, but the application can be done in the US with the necessary advice from US advisors. Both my colleagues on today is Stefan and Andrew, are both licensed advisors, mortgage and insurance advisors in Ontario, Canada. I'm your moderator and facilitator. My name is Raymond McMillan. I am a retired mortgage advisor, mortgage broker, real estate investor, and mortgage coach, who has spent about 30 years in the financial planning sector, 25 years in the mortgage industry. I've been dabbling in real estate investing since the early 2000s. I travel between Mississauga, Canada, Jacksonville, Florida, and Georgetown, Guyana, where I focus primarily on real estate investments and developments. So enough about me. I am now going to ask my two dear colleagues here to introduce themselves, starting off with Steph. Just tell the audience a bit about yourself, who you are, what you've done, and why we're here today.
Hi, my name is Stefan McMillan. I've been a licensed mortgage professional for 8 years now. As you can see, the moderator is my father, if you guys didn't catch that. I've been receiving the top producer awards through the mortgage industry for a number of years now. And I was part of this 2020 CMP, the Canadian Mortgage Professional Rising Stars magazine. What we're here today is to educate individuals about the reverse mortgage product. Just to echo what my dad said earlier, there is a lot of misconceptions of the product itself. And I'm here today to share some case studies that I've worked on with clients that had that thought process in an exception, but now see that the product has some benefits for their financial journey and retirement planning. A little bit about myself, as you can hear earlier, I'm a big music collector, particularly vinyls. I like spending time with my fiance, my family, and my friends. And again, thank you everyone for attending our webinar today.
Thanks for that, Stefan. Yeah, the apple doesn't fall very far from the tree. You grew up listening to good R&B music, so it's all part of the game, part of the process, part of the legacy. Andrew, let us hear a bit about who you are and what you've done and why you do what you do.
Yes, sir. Yeah, my name is Andrew Stewart. I'm a licensed estate and insurance advisor here in Ontario, Canada. I've been in the finance industry for over 20 years with a little bit of experience in mortgages, not as much as Ray and Stefan, but I do have some experience in that history. I've done home and auto and commercial insurance So I have a little bit of background or a little bit of taste on what finances mean for families, small business owners, and professionals. My true passion is really just educating our community on the power of life insurance and proper estate planning to make sure that not only you take care of yourself while you're alive, but take care of the next generation after you have left this earth. And my main focus here right now today is just to give you a glimpse of if you put enough effort into and educating yourself about what a whole life insurance policy can do for you, not only while you're alive, not only in an emergency state, but in retirement, using the infinite banking concept. That's what I'm hopefully to show you a little bit today.
All right, thank you very much, Andrew. Before we go any further, we start our presentations. A couple of housekeeping rules. One, if you can mute your mics, that'd be great, so we don't have the background noise interruption. We really appreciate that. And secondly, we want to be a very interactive conversation. So we want you to put your questions in the chat. Our format is very free-flowing. We want this to be engaging and for you to have any questions as we go about the next 40 minutes of our conversation. So I'm going to stop my screen share now so I can allow these gentlemen to share with you their presentations. Steph, can you go ahead? Sorry, let me just ask first, who wants to do their presentation first so we can get the conversation going?
I'll go right ahead.
All right, thanks a lot, Steph.
Can everyone see my screen? Please give me a thumbs up.
Yes, I can.
Okay,
I'm sure
thanks.
everybody else can also.
So this is a conversation about reverse mortgages. And particularly, I know we have some audience members in the US. In particular, this is about a case study in Canada. So I'll get right into it. So this is a case study about leveraging your home equity for health challenges. And I came across this interesting Dolet study, which I wanted to share with everyone. Again, the study is related to Canadians. So according to the recent study, 3 million Canadian households are expected to enter their retirement in the next decade, making it crucial to address their financial readiness. And I feel this case study I'm about to jump into kind of showcase and highlights that many Canadians are not prepared for retirement. They either fall ill. In this case, as you can see in my slide, that this individual had a cancer diagnosis. A little background about this client: I did work with her the previous year. She was healthy, working. She was in the healthcare industry. And then she gave me a call a few months ago this year to address a matter that she was diagnosed with cancer. She doesn't have any liquid assets, no savings, which is very much a common trend with our aging demographic here in Canada. They don't have any type of fallback reserve funds for any type of life emergency. In this case, she had to do a reverse mortgage. And I did address that to her early last year about the reverse mortgage, but she wasn't ready at the time. As you could see, the diagnosis of her cancer diagnosis made her realize that maybe this is something that she needs to look into deeper. That allows her to use the equity that she built in the home and take out any type of cash-free funds to support her treatment for cancer and also supplement her income while she's not working, because she was not planning to go back to work while she's preparing for her treatment. So as you can see in this case study, preparing your financing shouldn't be the last minute. Something shouldn't just occur and you react. As you can see, this was more of a reactionary response. And we should highlight and focus upon the fact that we need to have a financial plan for any type of life emergency. I know there's no crystal ball towards our health, but we have a good gauge on certain things that may occur. And I think we need to focus and speak to a professional about planning your retirement. Because once you retire, it becomes a lot more expensive. If you have grandkids, you want to buy them certain things, certain gifts. We have a colleague that came in maybe last year in his 70s, late 70s, and he was sharing with us that he spends a lot of time with his grandkids. They went to Disney World, and he was saying, and he was explaining to us how much money he spent. He has, I think, 2-3 grandkids. So you have to factor in that once you retire, either you continue working, stop working, you tend to have a more free time with yourself. So you may want to be into sports. I know the big thing is pickleball, like that among people, but I'm just using that as an example. You want to get into some a men's basketball league just to kind of keep you, engaged with other individuals like yourself and your health. But again, back to the reverse mortgage, it allows the person to tap into their equity that they built in for the last 40, 50 years and supplement their income or pay off some debt. And there's no monthly mortgage payments obligation required for this product. So that right there increases your cash flow tremendously once you remove that large mortgage payment out of your financial budget. So that's my case study for today, just highlighting those points.
Now, you mentioned this person had a mortgage here in your slide, about $300,000, which is pretty high for somebody who is in their 60s. What was the value of the property that this mortgage was on? So the listeners can put in context what her equity position was.
Yeah, her appraised value. So in this case, you have to use an appraisal report to determine the current value of the property. So
Okay.
the value was at $950,000. Given the fact that the style of the home was a townhouse, so there are certain criterias when it comes to a reverse mortgage upon the level of money that they allow you to have. And that varies on the type of home that you own.
Okay, so in this situation at $950,000, how much money was she able to access for her cancer treatment?
She was able to access about $100,000. Sorry, yeah. That's how much she could access at that time. Because just to put into more context, it's based on age when it comes to the reverse mortgage. So the sweet spot for a reverse mortgage is someone in their late 70s to early 80s. So you can go up to the maximum 55% loan to value of the appraised value of the property.
Okay, so at her age, she's 67. How much was the amount she was able to borrow, the loan to value, as you said, in relation to the actual appraised value?
In this case, it was 38% loan to value that she was able to.
Now, that's very important for the audience to understand, because one of the misconceptions is that most people who have reverse mortgages will lose their home because of the accruing interest. And particularly in the US, you've heard a lot of that kind of conversation. What we need to understand is that your property is appreciating in value in most markets between 4 and 8% annually. So if the reverse mortgage lender limits the amount you borrow, the probability of you outliving your home or even dying and having the entire home being debt, equity being erased by debt is highly improbable. There have to be some seriously extenuating circumstances for that to happen. Either the home is not being maintained and it's in very, very poor shape. But it's very clear, it's very important for listeners to understand that while you're not paying a mortgage payment and the interest is accruing on the reverse mortgage, your equity is also building, and there's a limitation on what you can borrow based on the value of the home. How many clients have you noticed in the last, since you've been in the industry, who found themselves in this position where they've got health issues with no real savings and very little medical insurance or medical protection? Is this something that's common, or is it something that is very infrequent?
I think during the pandemic, I've seen a larger cohort of individuals in that age group or that are experiencing some type of ailment, some health issues, and they typically don't have any type of reserve fund, no insurance, where they don't have anything, no support system from family members. Typically, they're a single woman, and they have to consider the fact that they still have a large mortgage, typically sometimes over 500,000, and it puts them in a difficult position where they may not be able to qualify for a reverse mortgage, because it's also the maximum loan to value is up to 44%. And ideally, for a reverse mortgage, to get the large sum of money that you want to get, you should be pretty much mortgage free. So to your question, I've seen a large number in the last couple of years of individuals who are typically single women, who are experiencing some type of health issues, no reserve funds, and they're looking for assistance. And it's typically a mortgage-related product.
Well, I mean, that's a good side. I mean, at least they had a home with equity in it. I mean, if they were rented, it would be very, very extreme circumstances. Now, I guess for our US listeners, they're probably a bit alarmed by the value of this townhouse for $900,000. Yes, Toronto is one of the most expensive real estate markets in the world. Our property values here have gone off the chain in the last 10 years. The appreciation in some cases is 23% annually. So there are a lot of people who have created a significant wealth through owning and buying homes in many parts of Ontario, particularly in Toronto, Vancouver, Montreal, and parts of Ottawa, Canada, which is the nation's capital. So those four cities and the surrounding geographic areas have seen substantial increases in real estate values. So the median price for a home in Toronto is about $1.2 million. For folks in Virginia and the DMV and parts of Florida, $1.2 million is a luxury home. We sit on the waterfront and 2 acres of land. But I digress. But yeah, so the Deloitte study is very, very clear. I mean, Canada has one of the largest retiring populations, or one of the largest aging populations in North America, probably globally. We expect a very, very large cohort going to retirement. There's been studies being done that the old age security and the Canada pension plan, which are all government-funded programs, are not going to be around for the next quarter century to help people fund retirement. So the planning process is very, very important. And that's by understanding where the reverse mortgage fits in and how it works. It's paramount to you enjoying retirement, whether you're healthy or well. If you're healthy, then you've got lifestyle expenses. If you're not very healthy, then you've got the medical expenses. So I mean, it's very important for us to try to maintain our health, so we age well. But anyway, anything else you wanted to add, Stefan?
I just want to add quickly that the image on the screen right there is to more evoke people to take their health forward. I know this case study was a little, we hear cancer, it's like that, the boogeyman, but like I wanted to put an image where we encourage more of us to focus on our health and wellness. So that's when I just want to add into the imagery, just a little context of why I picked that image for us today.
Okay, all right. Thank you very much, Stefan. We appreciate it. Any questions from the audience? Do you want any clarification and on the product and the process? You know, if anybody's considering, doing this for themselves, I would suggest they speak to a insurance or mortgage professional so they're going to walk them through the process. If you've got elderly parents who've got a home that's mortgage free, you know, perhaps, and they can't qualify for traditional mortgage, perhaps the reverse mortgage product is something that may work for them based on their circumstances. But again, you need proper advice. You need to make sure that the product actually works for your long and short-term goals. And if you have, adult children, you may want to have a conversation with them before you go through the entire process. Okay. Thanks a lot. So I know Andrew is probably waiting patiently to share with us his case study in the infinite banking concept. The infinite banking concept is an insurance product offered by most insurance companies in North America, and Andrew will now go through that process with us to show us what the product can do for us. Andrew.
Thank you very much, Ray. I want to thank everybody who is joining our webinar and our presentation today, and hopefully you take a little bit of more information than you had yesterday. So I'm going to be touching on a story about a mother and a daughter. And just like Stefan's case study, this is a mother who basically had cancer. And so right here in Toronto, 55-year-old single mother, and I'm just going to change her name to Jane for sake of privacy. She faced a life-altering challenge. She was diagnosed with ovarian cancer. Now, she grappled not only with her health, but also with the financial and especially the emotional repercussions of the disease. Now, significant gaps remained, particularly in terms of lost income, transportation expenses, and keeping up with the bills and expenses. So hopefully this will show you how having a specially designed participating whole life insurance policy, which was designed for the infinite banking concept, was able to step into a time of an emergency to provide much needed support during a time of a health crisis for this single mother. So the challenge. Now, while Ontario's public health insurance covered most of her cancer treatment cost, cancer just didn't bring medical struggles. It disrupted her entire life. So Jane had to take time off of work for treatment, which led to substantial reduction in her income. Now, additionally, she had to now travel to and from medical appointments to a specially designed cancer center, added to the financial strains and costs for gas, parking, public transportation really started to pile up. She was able to get help from friends and family, but she was an independent woman. She didn't like to depend on people or bother people too much, so she tried to burden a lot of those costs herself. And the physical and emotional toll was no less daunting. So the ovarian cancer brought symptoms like abdominal pain, bloating, pelvic pain, and the treatments, though were going to be life-saving, also caused side effects like nausea and fatigue. So this woman not only had to deal with the mental side of things, but obviously the physical side of things. And most distressingly, she faced emotional distress, grappling with the anxiety and uncertainty, definitely about her future, and worried about her daughter who lived in BC. Okay. So just want to give you kind of the picture of what this lady was going through as a single mother living by herself, battling this ovarian cancer challenge. So what did she come to me for? Now, I was working with her as her financial advisor, and we've been working together for a long period of time. And when we were talking about her savings, we had a conversation of, okay, your savings is really about where do you want to put your money? And after long conversations, we said, you know what? She wants to put predominantly her savings or the money that she is capable to save and attributing to a participating whole life policy. So at this critical juncture, her plan that we designed played a vital role. So she was always forward thinking. She was saving $10,000 a year for 10 years. Now, at the time of when she got cancer, she was 55. And at that time, the accumulated cash value in her policy was at $115,303, with also permanent paid up life insurance of over $400,000. Now, because the policy is designed for accessibility and using the policy while you're alive, we were able to adjust her financial strategy a little bit without compromising her already other investment vehicles, such as her RRSP or her TFSA. And as you can see, she had about $40,000 in her RRSP and $5,000 in a TFSA. Now, unfortunately, she didn't have a critical illness policy in place, which would have been able to provide that lump sum money upfront to her to kind of help out with these costs. But I just wanted to make that mention of why she didn't even have that in place as well. So when dealing with the situation, it comes down to where are you going to pull your money from in support? Where are you going to pull what from your savings? And what are the ramifications if you pull it from your long-term savings or your retirement savings, which was her RSP, or her emergency fund, which is TFSA, which were two options that she could have withdrew the funds from. Now, we chose to use her policy. And the reason why we chose to use her policy is for numerous benefits and numerous advantages. One, the withdrawals would be tax-free. So understanding her needs, we facilitated withdrawals of $20,000 for 2 years from her whole life policy, and this was totally tax-free. So this move was pivotal. It allowed her to supplement her lost income without draining her retirement savings, which was her RSP, or interrupting her investment growth because they were doing quite well. And if you take the money out, then obviously you're not earning the same type of returns on the same type of balance. Moreover, the option to pause her annual savings of $10,000 into the plan, we were able to do that, which alleviated the financial pressure of having to come up with those savings as well. So not only was her policy continuing to grow, her life insurance was still in place just in case, knock on wood, the worst would have happened. And she had that money available to her in and out to supplement for her incomes. So I just want to show you kind of how it works from a numbers perspective of what a policy like that was able to do for her. So first thing I want to point out is, as you can see, the $10,000 were going in each year. And the next following point that I want to point out is that we were able to stop those $10,000 deposits. So what that meant is that she no longer had to stress about having to keep up with her savings goals. Next, you can also see that we took out $20,000 out of her policy each year. And in the end, even though we took out $20,000 or $40,000 out of her policy, when it comes down to her retirement and what is projected to be there in her retirement years, we still have over $100,000 in cash value growing each year. And her life insurance, although it dropped because she took out some money and stopped making the payments into her policy, it can still continue to grow even after that, after the policy was fully paid for. Her policy stopped paying for her in the 20th year when she was 66. So she no longer had to make any more deposits into her policy, and she still has that cash value and life insurance growing for the rest of her life. So hopefully this was just a quick synopsis of how a properly designed policy can step in, provide you some capital, and still have that death benefit in the end for you growing for the rest of your life.
Thanks a lot, Andrew. That was a very good presentation. I learned quite a bit there. Couple of things. The RRSP for our listeners is a registered retirement savings plan, which is a federally regulated program that allows your investments to grow tax-free, much like an IRA in the USA, in the US, sorry. The income is taxed when you take it out, right? The TFSA is a more recent addition to the investment portfolio in Canada. It's a tax-free savings account. What is the limit now for the TFSA, Andrew? Last I know it was $25,000. Is that more than that now?
You mean annual deposit that you're able to put
annual
to your
deposits,
TFSA? Yeah, it's 6,000 right now for this year.
6,000. Okay, so you can put money in, you can invest money in this vehicle up to $6,000 annually, and it grows tax-free. There's no dividends, no tax paid on the dividends or the capital gains earned. Very good vehicle. I don't see any questions from the audience. If you've got any questions, please put them in the chat. We want you to ask your questions if you need any kind of clarification. But I've got a question for you, Andrew. I know in Stefan's case, the woman was already, I presume, retired or working part-time. In your case study, this was a much younger person.
Yes.
In her 50s when she got diagnosed. I presume she was still working. What type of benefits did her company have if she was a full-time employee that allowed her to meet the expenses for her health diagnosis? Was there any kind of group insurance plan?
What she had was long-term disability. So she was able to have access to, I think it was 66% of her income during that time when she was taking time off for her treatments. So her income coming into the household was reduced, although it was through her work benefits. And then she had to make up pretty much the rest to keep up with her bills.
Okay. And she had a mortgage too, did she?
Yes, she did. Okay.
So we're assuming it's about a $300,000 or $400,000 mortgage. She's a single mother. Was the child an adult or was the child below the age of 21?
Child was adult. They lived in BC.
Okay.
So the child wasn't there, unfortunately, to kind of help out. With bringing her to her appointments or to step in with, because she didn't want to burden her child. That was her main thing with asking for financial support, because the child was out in BC supporting themselves, supporting their kids. So that was something that she didn't really want to do. So she tried to burden a lot of the financial costs herself, which was her goal. And that's what we were looking at, of what out of her savings or her capitals, which one would make sense.
We have a question here from the audience. Can that strategy work with a term life insurance policy?
Sorry, what was the question again?
Can that strategy, what you just outlined to us, can that work with a term life insurance policy?
Unfortunately, no. So term insurance is just pretty much pure cost of insurance. So you're transferring the risk of you dying prematurely to the insurance company. You pay your premium, they cover you for that certain amount of coverage, but there is no cash value or capital growth inside a term policy.
Okay. And that's a very good question. And that brings us back to the need for Caribbean and Black folks to plan. I know we had a conversation yesterday. We spoke about the importance of budgeting and planning. And we've seen two scenarios here. Unfortunately, there were both scenarios that are people who developed life-altering illnesses. And I know this is a heavy subject for a lot of people and people that are intent to do this, but it is important to understand the nature of life today. And there are many people being diagnosed with serious illnesses. And there are products out there that can help you to navigate your circumstance a lot easier. Both the reverse mortgage product, which is, something that a lot of people are reluctant to do. I think the need is for us to understand the product. And the other is the infinite banking concept. Both of these are what I would probably call more sophisticated financial products, where by sitting with a financial advisor or an experienced mortgage advisor, they can sort of help you navigate the financial landscape based on your circumstances. And for many of us in the Greater Toronto area, we are immigrants, mostly first generation, probably a few second generation. Unlike the US, where more people have been there for a longer period of time. So many people are by themselves because of the nature of the immigration programs in Canada. We've seen a large number of female immigrants that were brought into the country during the 60s and 70s, and they're aging. Many with no family support, and many are single, either single, divorced, or widowed. So I think it's important. I mean, both Andrew and Stefan in their case studies have shown to us the importance of prudent financial planning, that is building the budget and that sort of stuff. And there's a reluctance for many melanated folks to, in your answer to the question we had earlier from one of our listeners, with term insurance, to buy the cheapest insurance products. And I mean, correct me if I'm wrong, but I don't think term insurance goes beyond 75 years. Is that correct, Andrew?
Well, it's fun. It's the industry is changing in that regard. So before, all term insurance had an expiry date of 80 or 81 years old.
Okay,
And that was standard. But now the product is actually changing, where term insurance is now becoming a yearly renewable after the time frame or the term period has done. So what they're doing right now is that we're realizing that people are ending up with no life insurance. So we are going to change the product slightly and saying we're going to allow the policy to continue on for the rest of your life, but you're going to go through a renewal each year at a higher premium. So it doesn't alleviate the cost issue when it comes down to people having life insurance, but it does alleviate the automatic expiration of your policy. So if you can still afford the renewal, then you can still have your life insurance.
Okay. That is very good to know, because in my experience, I thought but I previously sold insurance in my previous life, many years ago. I knew there's an expiry date. But yeah, coming back to what we were saying earlier, I mean, it showcases the importance of financial planning. And it is something that a lot of melanated folks don't do. A lot of what we do is reactionary to circumstances. And in Stefan's case study, it showed very clearly what that lack of a plan does. I mean, we've got a person who's 67 years old and they're still working because they have to work. They had basically no savings. They had a pretty large mortgage, $300,000 mortgage. 67 is a pretty large mortgage. I mean, that's, probably would take about 15 or 20 years to pay that off. And then you had the flip side, where somebody had worked with an advisor from her mid-40s and had managed to put aside some money. Now, if she started working with an advisor in her 20s or 30s, could you imagine how much further ahead she would have been? So, I mean, we want people to understand that the necessity to have that plan, to have that household budget, to have that monthly budget. And yes, I mean, the budget does not have to be carved in stone. You can work around the budget, there's some level of flexibility, but it gives you some sort of roadmap of where you want to go. And if something happens to you where you're blindsided, then at least you have some fallback. But if there are no financial resources in place, then you have no fallback. We've got another question here from the audience. Is there a whole life policy that is more favorable with someone who has a pre-existing health condition, a heart condition? I mean, Andrew, you want to tackle that question for me? If the
Yeah,
person has a
so
pre-existing health condition, are there any whole life policies that will allow them to be covered?
so that's a great question. So it's not so much the policy, but the carrier. Traditionally, regular carriers, if you have a pre-existing condition, obviously depending on what that pre-existing condition is, will either A, decline you based off of that condition if it's, you know, cancer or heart attack, or rate you depending on how long you've had the condition and what's stable and what the stability that condition is. But there are carriers that offer products that specialize on if you have pre-existing conditions, and those carriers will obviously charge you more for the premiums. The policies themselves can still be a whole life, but most of them are just whole life straight insurance. So you'll have the amount of insurance in place, you pay your premiums. Most of them don't have high cash value growth capabilities inside them, but you are stable to get permanent insurance with those carriers as well.
Okay, thank you very much, Andrew. I hope that answered your question. And again, I mean, to reiterate, we've seen that one of the ways to create intergenerational wealth is by understanding the products we have at our disposal, both mortgage products and insurance products. And I think that was displayed here very, very clearly. In next week's conversation, we want to possibly focus more on how do you use these two products to invest in real estate or to build your portfolio as you go into your retirement age. We want to try to get away from the quote unquote morbid conversations of death and illness. I mean, we know it's part of our reality, but we also want to show you that the products can be used for other purposes that can help to create wealth for our future generations. You know, we can make reference to many very, very wealthy American and Canadian families who over the years have used insurance products and leveraging mortgage products to create tremendous amount of wealth. So our purpose here is to educate our audience, and we welcome the questions. We don't have all the answers. We don't know everything, but between the three of us and our probably almost 60 years of experience in the insurance, mortgage, and banking industry, we can probably give you some pretty good solutions. So it's a minute to 11, sorry. You know, we're very, very conscious of our time. You know, everybody's got very busy days. Stefan, you want to say anything before we wrap up?
Yeah, just some closing thoughts. Again, this was a great presentation from Andrew and myself and my father. Hopefully we take this conversation and share this with our loved ones, more importantly, and be more involved with our parents, grandparents when it comes to financial planning in their retirement process. And what I mean by that here is that, particularly in Canada, there was an uptick of fraudulent activities with the elderly. And I feel that we have a responsibility as the children to be there and make sure they make the most beneficial choice when it comes to their financial planning and their retirement. And again, if you guys have any questions or there's some type of topics you want to hear from us, feel free to put in the chat or email us. We'll take that to deep consideration.
Right. Thank you very much, Stefan. I appreciate it coming up with the fraudulent activity against elders in our community. Any closing comments, Andrew?
Yeah, I just want to say thank you, everybody, for joining and taking the time out of your day. The best time to start a plan is today, but think about if it's not yourself, if you think about somebody that you love, somebody who has either gotten married, had a child, bought a house. Those are milestones where it really starts to make sense to kind of look at where you're at, where you sit financially, and start planning for the future. And I hope you guys enjoyed it.
All right, thank you, Roy. Now I've got the contact information for both Andrew and Stefan on the screen, so let me know if you can see it. Andrew's a chartered life underwriter. You can go to his website, dfinsuranceSolutions.com, or email him at info@dfinsurancesolutions.com. Stefan is a mortgage agent. As he said to you earlier, he has been in the industry for 8 years. I would probably correct that, more like 25 years, because he was always in the office when I was actively doing business. So he's got a lot more experience in those 8 years that he's actually been licensed. You can actually connect with him at the McMillanGroupInc.com. His email is stefanmortgage81@gmail.com. For anyone who wants to get in contact with me, you can also get in contact with me through our website, McMillanGroupInc.com. Thank you very much. Thanks for taking the last 45 minutes to spend with us. We appreciate your time. We don't take it for granted. Folks, have yourself a fantastic day. Stay healthy.
Thanks, everyone.